Joining me now on the line, very pleased to have back to the show, I've got Bob Hoye, Institutional Advisors. What a perfect time to have, Bob. Bob, appreciate you finding time for us.
Mike, good to be with you and with your listeners.
So much to talk about, but let me just start with the Federal Reserve's decision this week. Once again, we're not raising interest rates. Yeah, I know we said we would 4 times when we were in December. Yeah, I know we said we'd continue doing it. And then it was going to be June. Then it was, nonstop. Is there a message here? I mean, that they didn't do it again? What should we take from it?
Yeah, the message, Mike, is that the Fed is finally being seen to be ineffective.
Yeah.
And they also, I think, in the last few weeks have realized that they're ineffective. But we should look back at the history of, at least since the 1870s, on great financial manias. The senior central bank, which was then the Bank of England, was about 4 or 5 months behind the natural change in interest rates. Mm-hmm. So anybody who's sitting there figuring that the Fed knows what's going on, that's improbable. And that they can make an effective policy, and that's improbable. So, in the 1930s, the T-bill rate went down to 0, and it was because the Fed was forcing money into the markets, and the money wasn't being employed in industry. And so I was looking like in 1937, it went into the stock market. So this was the problem with central banking: is they're not connected to reality, and the main issue is that the public chooses what to speculate in. So you had the Fed incredibly easy during the 1970s, and the big speculation was in commodities, consumer price index, and wages. And then everybody got turned on to that and said gold was going to go to the moon. And then in 82, the financial world shifted over from speculation in tangible assets to speculation in financial assets. And we've been in financial assets ever since. And no matter how hard the Fed pushes in hoping to get an expansion of GDP, the money will go where the public is speculating. And for the last few years, it's been in low-grade bonds, a brief run in commodities, and not so much in gold until recently. So, and plus real estate, high-end real estate. So this is a demonstration that the Federal Reserve is not hooked to reality. And I think that we are looking here in the financial markets where the change is going to be. Already, the yield curve for the last 5 weeks has turned to flattening. That is not good for the banks. And, of course, the Federal Reserve has no influence on when the curve is going to change. And then the other one is that you've had a terrific narrowing of credit spreads since the catastrophe in January. So first part of that was due to, the rebound out of a distressed bond market. And then the next phase, which is right on until just a couple of weeks ago, is there's a seasonal narrowing of credit spreads. So we've had that terrific narrowing of spreads, and some spreads for the last 2 weeks have turned to widening. And the main one we watch, which is the Triple C against Treasuries, it's just had a week of beginning to turn. So this is what guided us in 2015. That changed there. It was widening credit spreads that pushed off the problem in Shanghai. Nothing to do with policy of the Chinese central bank or the Federal Reserve. It's just the natural change to widening spreads. So to debate where the Fed is going to go with policy isn't going to be helpful.
It's interesting, and of course, let's not forget they're the only game in town. I mean, one of my statements, at least, is that how hard governments work against economic growth. They talk that game, and you turn around and you watch them with higher taxes, mandatory transfers, talking about it right now with more transfers to government through Canada Pension Plan. Everything takes money out of the system. Then you got the regulatory burden. So I think the Feds sit there and the central bankers think we're the only game in town. But as you say, Bob, they don't have control of, they lower rates. They can't tell me what to do with that money. And now you throw that Brexit vote on, and look at that stampede for safety. I mean, the U.S. government bonds. I saw, we saw it in Germany. I talked earlier about those Swiss bonds maturing in 2049, now gone big time minus. I just see this system as not solvable at this point.
the only thing it'll solve is to get rid of the artificiality.
Yeah.
Now, financial markets, private, without an aggressive central bank, can get highly speculative on their own,
Mm-hmm.
and then usually it crashes. But what you have here is that not only have private investors become speculative, but the central bankers, first of all, the theory that they can successfully intrude in the marketplace itself is highly speculative. Then the other one is that they've taken their usual push a bit, pull a bit here, and stretched it to infinity. So it is three levels of speculation: private, a speculative theory about intervention of central banking, plus those central bankers going absolutely mad. So they can't win forever, and what we're looking at now is a seasonal turn to widening credit spreads that worked for us in 2008, 2007, and even in 1998 when long-term capital management was discovered to be on the wrong side of a trade, and it was just the seasonal change to widening credit spreads that brought them down.
What's the implication of that then for investors? What should they be looking for at this point?
Oh, I think that the long-term treasuries and Government of Canada's now are on an uptrend. The treasuries we used, the TLT, got up to 135, which was a target, and it'll exceed as commodities get a bit weaker in here. But these yields are exceptionally low, or prices are exceptionally high, so it's very difficult for investors to find a place to park. So what we suggest in the for safe money is get in the 3 to 4 year treasuries, the U.S. treasuries for Canadian investors, because it looks like the U.S. dollar is about to start to take another leg up. So then, sure, you got low yield, but at least you'll make a little bit on the currency trade. Now, on low-grade stuff, it's going to be another disaster. There's also seasonality in there where the best may be around May or June for low-grade credits. The worst can be found around October or November, and you've had excesses again here now in the credit markets that Mother Nature is going to tend with. So,
I'm talking with Bob Hoye with Institutional Advisors. Just go to institutionaladvisors.com. I'll come back with Bob. We'll talk more about what it all means to you, but I just heard a very big warning, a very big lookout. We'll chat more about that when we come back on the Money Talks Network. Coming up, my favorite story I read this week, a new way to sell a business. I'll share with that in just a couple of minutes. Right now, though, very pleased to have with me Bob Hoye, Institutional Advisors. Bob, let me just come back. You were certainly hinting on it before we took a break, and that is, what's the biggest danger area for individuals and their investments?
Well, first of all, government. But one of the things is any price that is excessive now, and the price of high-grade bonds are exceptionally high. They may stay high for a month or so yet. The price of low-grade bonds has been exceptionally high. They've had this year, the last few months have been very good, so they're high. And the price of residential in Toronto and Canada is exceptionally high. So the danger is to join the crowd on a very popular trade, and there are other things to do, but the problem is in the real estate market, if a young person does not yet have a house, you're going to be forced to save enough to get in, but you can't trade your house. But these are the areas that are exceptionally high priced, and in a few years, like you can't call the trade for tomorrow, but we know that high-end residential real estate in England has suddenly gone no bid, and the same in New York, in Manhattan. It's suddenly a glut of both rental and condominium stuff. So it looks like the mania in residential housing has become overdone and is beginning to at least go sideways to slightly down. So I would say to younger people, just avoid excess and don't join the crowd, as in hey, all the lemmings are doing it. So, and the places where you have reasonably good opportunities is that in every post-bubble contraction, which we're in, the bubble really blew out in 2007, and we're in the first business expansion and first bull market out of that crash. And as a matter of fact, our view is that the bull market peaked last year, and this is just a rebound within the bull market. And so in the post-bubble contraction, deflation is a problem. You have weak commodity prices, which other than a bounce this year, you have. And eventually you get real interest rates rising. There's lots of noise now about negative interest rates. That's for a nominal yield where you will buy a bond and you get less money back when you have it redeemed. But the way to clear through that is where we take the nominal interest rate, which is the one that's published day to day or month to month, and divide it by the consumer price inflation, and they call that real interest rates. And it follows a regular pattern through a financial mania where real interest rates go down, and this has been the case recently. It was certainly the case in 2007 where real long interest rates, and for this we stay in the senior currency, so real long interest rates in U.S. terms with the 2007 bubble fell to about -1, -1.5, and then it got up to 3%. So you had about a 4 or 5% swing increase in real long interest rates in the contraction 2008, 2009, and that was rather severe. But if you look back in the history of real long interest rates on each bubble, the typical increase in real long interest rates has been 12 percentage points. 12 percentage points is a huge increase. And it seems to be a trap that Mother Nature puts in the markets because the financial mania is, no matter whether it's a central bank involved in it or just regular people and corporations, is a building disaster. And so what happens is that Mother Nature likes to correct excesses in the financial markets. So in the past post-bubble contractions, real interest rates have gone up at the high-grade end by 12 percentage points. So that is a brutal way of stopping the abuse of credit markets. And then on each of those ones, the markets went about allocating credit, and also the other part of a post-bubble contraction is that the senior currency becomes chronically strong relative to most other currencies and to most commodities for most of the time. And this, of course, has been the issue is here, like the Federal Reserve is boosting the credit markets, hoping to get inflation up, which means hoping to get material prices up, producer prices, commodities, and other than some swings. It's not happening. So this all comes around to a circle whereby the Fed is pushing and the markets are not following according to the rules of the Fed. And this is where I think this week's Janet Yellen announcement was a lot of critical analysis that said that, it's not working. And so also this is where we think that once enough asset prices declining, then that shuts the door on the Fed trying to get credit out the window. They need outside speculators to borrow money aggressively in order to get their portion of credit expanded. And it'll go back to the 1930s where the description of Federal Reserve activity was pushing on a string. Hey, it doesn't work.
Well, I think
So,
that's certainly the hint that we've seen. I mean, my gosh, we're just doing the same stuff. We haven't had the result. We've had unprecedented central bank action, unprecedented in terms of quantitative easing, record low rates, all of that stuff, and you still look at the level of economic growth. It just hasn't worked. But Bob, time is out here, but I just want to reiterate. So you like the U.S. dollar there? Let's be careful. At some point in the near future, you're going to be locking in your borrowing side of things in anticipation of a jump in rates. So, we're in that time frame now to be worried about that.
well, we've got a special study on real long interest rates, so people can tap into the website to have a look.
That's institutionaladvisors.com. Bob, as always, we so much appreciate you finding time for us.
Fun to be with you, Mike.
Bob Hoye, one of our favorites. I just should have started with this. I remember Bob coming on with us right at the top of the Dow, 2007, 8, and he says there's going to be a credit tsunami happening, the likes of which you will not have seen in your lifetime. And, of course, the credit crunch showed up right on time for Bob. Pay attention to what he's got to say. Go to institutionaladvisors.com.